Hello, everybody. I just received the message that all planes and all trains from Cologne Airport and to outside are cancelled for today due to the snowstorm. So therefore, I brought 300 pages, and we will stay for the rest of the day talking about finance. I love to stay Friday evening with you here and go in detail on all the measures here. Anyhow, so let's go into the financial session as the final round here. And before I start my presentation, let me say over the last year, I think it would be fair to say that Deutsche Telekom is much more predictable and reliable for shareholders. And we tried to draft a story of prudence here and even of predictability, and that is exactly what we are trying to do as well for the upcoming years. We know that we change our strategy towards more investments into two areas, in Germany and the US. But we want to bring that into a financial envelope which is prudent and which is predictable and which is reliable for you. And only to do that from the beginning, to give you, let's say, what is the story behind the story. The first thing is our balance sheet is not under pressure. We are not in trouble as some of our peers in Europe. Second, we have 85% of our businesses in, as you call it, safe haven markets. Thirdly, we are not under-investing in these difficult times. Deutsche Telekom is not investing. The opposite is the case. You could criticize us for investing, even more on an average percentage as our peers, in a time where a lot of our competitors are very defensive. Lastly, we are focusing on efficiency. Despite the fact that we are focusing on growth and that we're even focusing on increasing our market shares, we keep our pressure on costs, both on the OPEX, but as well on the return on capital employed. And lastly, this company is fully financed. We are fully financed as best industry terms. So that gives you an impression where we are at that point in time. We could do things which others can't do due to, let's say, this strong position in which we currently hold. Let me go into the review. And honestly, I got my grades from René yesterday already on this one. So therefore, I know that we have missed the return on capital employed. I go into that one later on again. But I would say, on the rest of the things which we have promised, we more or less delivered. So therefore, let me quickly go into maybe in one of the headlines, which I want to remember you on the disciplined execution along the last years, and very much focusing on financial KPIs here. The first is, in Germany, we have the best performing incumbent. That's definitely the case, and you saw the numbers in every category. We are almost leading in Germany. And at the same time, we were able to improve our EBIT margin by almost 4% points. In Europe, sustainable cash flow. Despite the macroeconomics, we have kept a stable cash flow, which is a philosophy by itself, by the way, to trying to manage an environment which is much more difficult to keep, let's say, the contribution of the business, which is not easy in Greece, I could tell you. But I think the local management take local actions to adapt to the local situation. And by the way, the same is right that we said we are not the deep pocket for the Greek people. They should refinance on their self. And I could say today that for 2013, we are fully refinanced in Greece. And by the way, without any support of Deutsche Telekom, and despite selling Hellasat or Globul. This is due to, let's say, a new refinancing condition which we achieved with banks beyond 2013. Thirdly, the US. You know the story about the US. But what is the story behind the US? The story behind the US is that we have invested almost 10 billion in the US without negatively affecting Deutsche Telekom's balance sheet. Nothing has changed on the overall picture of the balance sheet here in Germany, but we have invested 10 billion more into the US. How is that? We got something from the AT&T breakup fee of 4.2 billion. On top of that, we sold the towers for 2.5, which is 20 times EBIT. And we have, with the perspective of the Metro transaction, we own 74% of the projected synergies, which is almost 5 billion. And this money we take and reinvest into the competitiveness of the US business. We did the spectrum swap with Verizon. We got spectrum from the breakup. And we have the modernization of almost 4.2 billion for the renovation of our LTE infrastructure in the US market. And on top of that, we have the iPhone transaction, which is now helping us to invest money, which we have gained in the US, into the competitiveness of our postpaid position. And this is the philosophy how we think about it. Not just borrowing money and invest it, but trying to use the asset, squeeze the asset, change assets to get, let's say, a better competitiveness in the US. Without increasing, let's say, the pressure on our balance sheet here in Germany. The fourth example is Save for Service. This is a success story. We are now in every category, in every organization, we have learned, that we have to improve our OPEX basis. We have big benchmarking across the industry. We know exactly where our disadvantages are, and we have overachieved that target, and we will even commit to more with regard to OPEX in the future to close the gap to the best-in-class productivity. With all these changes in the group over the last year, we even improved our debt situation. We have reduced the net debt by 3.2 billion. So that is giving us a very good, balance sheet ratio with regard to our ambition levels here. This despite the fact that we have invested 1.7 billion into spectrum, that we had a negative current exchange effect, and that we did acquisition, PTC, we acquired OTE, some piece of it. We had the Strato acquisition, so that we invested almost 2.6 billion into new businesses. And the fourth topic is we entered into new scale activities. Scale matters in our industry. This is driving economic value added. This is driving return on capital employed. This is driving, let's say, the productivity of our assets and the network joint ventures in the UK, in the Czech market, and even in Poland. This helped us a lot, and the procurement of buy-in is even contributing to the overall situation. So this is not just fact. This is a little bit of philosophy, how to steer the business of Deutsche Telekom. By the way, we got appreciation for that one. We got appreciation on how you look at Deutsche Telekom 3 years after we have started, let's say, or even 5 years after we have started our program. And this is just the facts, and I do not want to teach you guys, you know that already, but this is how we look at this. This company is much more capital market oriented than it was 3 years ago. And we really care about your feedbacks, and we really care about the feedback we get from the KPIs here. And one of the feedback which we got from this is that we have significantly re-rated. By the way, strategically very important for us. Why? At one point in time, consolidation will take place in the European market. And then it's very important that your rating, that your multiples in this industry are ahead of the average of the industry, because that would give us a currency. And if you could see from the gray line, that was where we were in 2010. The average of the market was traded at 4.5, or 5.4, while we were trading at 4.8. So we were significantly below the market valuation. The red line is where we are today. On 2012 numbers, the current multiple is 4.4, while Deutsche Telekom is traded at 4.7. So Deutsche Telekom experienced a significantly derating over the last 3 years in this European environment. The total shareholder return of Deutsche Telekom, and I compare ourselves with the relevant peers here, is better. Vodafone has another business model. Vodafone is even FTSE, so they had even a better performance than we, but the rest of the industry in Europe, was significantly worse than Deutsche Telekom. And this is something where we say we want to be predictable and reliable, because in these difficult times, this is a brand attribute which we want to even to play in the future. And at the same time, we were very lucky, because 60% of our equity value is in Germany, and therefore, Germany is much better performing than the rest of Europe, and therefore we had significantly better financing conditions than anybody else. And you know that from a spread perspective, our 5-year spread's currently at 91, while our competitors are at 125, 170, or even 280. So therefore, we could refinance at very low conditions, which makes our portfolio a very well hedged one. So therefore, we are on the right way. Are we happy with the share price? Are we happy with, let's say, the feedback which we currently got? No. And by the way, I personally hold a lot of these shares of Deutsche Telekom, and therefore, we are not happy with this development. And the reason for that one is not the dividend or the dividend yield. The reason for us is we have to regain growth. This is the biggest driver for this stock. And therefore, our entire ambition, even the feedback which we got from you guys, was always, what could you do to regain growth of Deutsche Telekom? And the reason why we are coming with these huge investments into Germany, with these investments into the US market, because we think in these two markets, the opportunity to regain significantly more value by growth stabilization or even growth, this is why we have changed our strategy towards more investments into these areas. So now, how are we going to tackle that from a finance perspective? You have heard a lot of stories today from Nick-Jan. You have heard it yesterday from John, from René, about how we want to grow the business and how we invest into the business. The question of my presentation is, how is finance as a function supporting this ambition? And therefore, I'm focusing on our role within the organization. And I'd like to mention 4 areas of activity within the finance organization. First, onward efficiency management. Efficiency management, it stays and it is very important. By the way, both on the OPEX side and on the capital return. I think we are all underestimating the capital return issue. Second, if the question of how are we doing things is not giving us the right feedback, we have to question even the what are we doing. And therefore, we even have to question, do we have areas where with portfolio decisions, with portfolio changes, we might improve the value of this company. Thirdly, we have to stay prudent. Risk management is in these difficult times with the core business in Europe is one of the highest priority we have to face, and we have to manage differently in this kind of volatile environments. And the last topic is about how do we think about stakeholder management. And stakeholder for us is not only the owners of these companies, it is as well the debt holders of this company, and it's as well, let's say, the entrepreneurs of this company. So how do we find the right balanced approach from the finance perspective here in this regard? So you have seen all of the slides for each of the divisions already. Now, going up 10,000 feet and giving you the full picture of Deutsche Telekom. We said the driver for value of that company is growth. So therefore, we're investing into the business, but we're even investing into customer growth. So we are expecting growth not only from our core business, on top of that, we're expecting growth from the integration of Metro in its new markets and what we heard yesterday. So if we want to see that growth, we have to invest more. This growth is coming not just for free. And therefore, we have to increase, and that is on the right side of the slide, we have to increase the Capex. The Capex is going up from 8.3 to 9.5-ish, including the Metro, for 2015, and I come to the Capex profile later on. At the same time, if we are investing more cash into Capex, we could rebalance part of this Capex by less special factors. How is that working? We employ more people in Germany for building this infrastructure. So we could save some of the special factors. So we balance cash in the group by having less special factors for the upcoming years for the time of the build-out. On the other side, if we want to grow, we even have to increase the variable costs, because growth is always coming in our industry with, market invests, subsidies into the handset side. So therefore, if you want to see growth, there is in every industry in the telecommunication automatically an increase on the direct costs, our variable cost side. So if you look into our EBITDA profile, if you look into our cash flow profile, if you want to see growth, you even will see higher direct costs. So therefore, you cannot just watch the full picture, you even have to look into the details of our cost structure. The direct costs, they have to increase. At the same time, we are reducing our indirect costs. So this is, let's say, the focus of every cost measures that we say invest into the market, for instance, 200 million more in Germany next year, into improving our market leadership, both in fixed and on mobile, but at the same time reducing everything what is needed, not needed in this company. Reduce the indirect cost significantly. On top of that, and I go into that one later on, you could say, oh gosh, these guys are investing more. So their net operating asset basis, their capital basis is increasing. So the cost of capital is increasing as well. What you might know from your models is that we have now depreciated a lot of, let's say, assets from the past. And by the way, I'm not talking about the impairment issues here. I'm talking about, for instance, RAN infrastructure, about Linientechnik from German's infrastructure coming from the reunification. And this is now depreciated, this asset base. So in the future, you will see significantly less depreciation of Deutsche Telekom, despite the fact that we are increasing our Capex for the modernization of the US and for improving our broadband infrastructure in Germany. This together is driving the return on capital employed of this company. This is improving the return on capital employed of today of 4%. We know that is not sufficient, up to 5.5%, in 2015, 150 basis points. And by the way, that sounds not big. This is an increase of 40%. 40%. And I will go into this return on capital story thereafter. So this is the picture, how this business model will change in this dynamic of more investment into markets, more investment into infrastructure, while at the same time reducing our indirect costs. So talking about a little bit about Capex. Capex, 2 programs, by the way, very focused. We are not investing everywhere. You have heard that from Reinhard and Klaus just in the presentation before. We keep the level of Capex in Europe, where it is today, but we will increase in the 2 areas where we put our chips on the table, which is INS in Germany and which is the network modernization and the PCS integration in the US. 6 billion total program for Germany. We ramp it up now. It will have, let's say, half of a year 2014, and then kicking in 2014, 15 and beyond. So we will have 4.1 in 2014, 4.3 in 2015, and then for 2016, 70 in this vicinity, even slightly higher. In the US, we have started our LTE modernization already this year. It's a 2-year program. So there is another peak coming next year, but then with the Metro PCS even higher, 4.7 to 4.8, including the Capex for the synergy realization, but then going down to a normal level. And with these two measurements, which are temporarily a little bit, let's say, delayed, we get an overall Capex profile in the vicinity of 9.8, 9.5 over the next years. For the next 2 years, before the growth, the payback of the infrastructure investments, the turnaround of the postpaid business in the US is kicking in, we have a lower Capex, which is the 5 billion number, which we already mentioned. And I will show you the cash flow profile of this 5 billion for 2013 in a detail now. 2015, with the growth prospects, with the perspective which we have in the group, we return to a 6 billion number. So if you question, how do you come up with your dividend story? The story is that we foresee a certain high level of investments and free cash flow reduction for the next 2 years. We link our dividend commitment, predictable and reliable, to this cash flow. Thereafter, we see an increase of cash flow, and it would be unfair to already commit to the same level for 2015. Therefore, we say, with the increase of cash flow in this year, we then will review our dividend again. How is the free cash flow developing? And I think that is very important for you to know. This year, we are very comfortable on our way with regard to the 6 billion. You saw that already in the 3-quarter numbers. We have a very strong cash profile in the group, how we manage the assets throughout the year. If I would just forget about our focus investment strategies for US and Germany and just move on, the free cash flow for next year would increase. Operationally, without investments, we would see, on the one hand, the EBITDA impact from the businesses which are slightly declining. On the other hand, the integration of Metro PCS with its EBITDA performance, so an EBITDA improvement of 600 million on the free cash flow profile. There are measures on operating working capital of 200 million, and there are less restructuring cash outs, which we foresee for next year of 200 million. With the others together, we would be in the vicinity of 7 billion cash flow for the next year. So a very rich cash profile. Now we took this as a very strong position to say, this is the right time to take part of this money and invest it into our infrastructure. And therefore, we have the investments which are affecting our cash flow. First, 200 million into market invest into Germany. You saw this great track record which we have on the LTE, on the Apple iPhone here in Germany. You saw, let's say, the 550,000 net adds on postpaid. We want to keep that momentum and invest even more into this valuable postpaid area in Germany. 200 million. 300 million on top of is going into the ENS, half of the year. Then we have the total effect of Capex for the US. This is now cumulative, a lot of areas inside. It is the peak investment into LTE, and it is the cost for the synergies which we have to, pay in the first year to get them realized over the periods thereafter. This is, let's say, the total area of integrating Metro into T-Mobile and at the same time the LTE modernization. And then we have the gross impact from the value plans, including the Apple impact for next year. Maybe we could later on in the Q&A talk about, let's say, why is that this amount of number and how is this business model of working capital working? It is not SAC, it is a working capital impact which we have with the value plans, and therefore we have this gross effect, by the way, partially managed by the working capital improvements in the US on the left side. And then we have some cash savings in Germany on top of that, which is 500 million. By the way, this is due to the fact that we are focusing on INS while we are reducing investments into legacy systems. Less into the old infrastructure, so we are able to refinance part of that INS next year by reducing our overall Capex burden in history. So this will bring us in the vicinity of 5 billion. And by the way, this 5 billion is right, including Metro PCS and excluding Metro PCS. So that is the reason that we say whatever happens next year, this group is going to make 5 billion of free cash flow. For 2015, 2 drivers. The first one is the operational turnaround in the US, a big driver, by the way, for 2013 already, for the improvement of our story. But this is one of the drivers for the 6 billion number. And the second is the improvement on the revenue profile, both in Germany and as well in Europe. This is the Capex piece. I mentioned the cost piece as well. On the cost side, and that is now maybe something which we didn't have to communicate in the past. Because in the past, we had always a shrinking business, and in a shrinking business, both direct and indirect costs went down. Now, anticipating growth, the direct costs are going up. 26% of our revenues in 2012 are direct cost, market invest, customer growth. This is going up in our planning to 29%. Now, the good message with this is, if growth is not coming, this cost will not come as well. This is absolutely, let's say, linked to the growth profile of the group. So if you would not see the growth, this is automatically windfall, for the profitability. On the other side, you see the indirect costs, which is today 44% of our total revenue. And our ambition levels now, they are to reduce this indirect cost from 44% to 42%. How are we doing? We have a program of 2 billion. Is that enough? No. It's not enough, and we are striving for more. We have the benchmarks in the group. We want to close the gap on the performance to the best-in-class peers here. So there is more to come. But we have to talk about things which are predictable. And if I talk about what are the programs, just to mention some highlights, there's 1 billion indirect OPEX reduction in Germany. There is 600 million coming from indirect OPEX reduction in Europe. There's a huge program up and running in Europe. And then we have in our shared service functions, which are mainly yet in the GHS, a 4% per annum indirect OPEX reductions for every single year in our planning cycle. In the US, indirect, we save money. Direct, we invest the money. So there is a gross impact. There is no net impact. While the 2 billion are net impact. So therefore, there is a balancing effect here, which you have to consider. And Telecom IT, only to mention that, is another area Klaus Werner von T-Systems laid out earlier. So to give you a flavor about the content, back office transformation is a big issue. Shape our core, shape our crew, so shaping headquarter, 40% reduction is on its way here at the headquarters, and we will trigger other programs across the group. Second, IT modernization, mainly retirement of platforms, is a big driver. Desktop modernization, only to mention one. We have in T-Systems the master plan business, which Klaus mentioned in his presentation earlier. And then we have this e-company approach, the more automation, the avoidance of certain service issues within the group, which is another driver for these things. And the last one is the NT transformation, the all IP transformation, which hopefully came across while Claudia presented the technology strategy. I think all IP transformation is going to be the biggest game changer for our industry in the midterm perspective. Comes with some Capex, but at the end of the day, fundamentally changing the business process, how we are operating in an all IP environment. So therefore, you see that we are striving for cost savings, and I could tell you this is not going to be the end. This is just, the extension of our program. We are working on even, more savings in our footprint. Yesterday, some of you guys said, investors don't care about return on capital employed. Honestly, I found that frustrating because I'm caring so much about return on capital employed. But for us, return on capital employed, and I thought this morning about why is that not relevant for you? Okay, you take the price of the asset as it is today and you don't care what is in the past. But if we could improve the return on capital employed, so investing less and squeezing more out of the asset, this must be relevant for you because this is creating value. So therefore, I think it is very important to consider or even to mention that return on capital employed is and stays an ultimate and most important criteria for us as a company. I know that we are much more focusing on this one than other competitors, but the funny thing with this is we are benchmarking ourselves. And please do that if you have, some spare time by waiting on your flight tonight. So on this return on capital employed, what you will find out is all peers in Europe have lost significantly return on capital employed, while Deutsche Telekom at the same time, against the trend, improved their return on capital employed on the assets. So in the benchmark, we see that the efforts behind this initiative is worthwhile doing it. And I can tell you, we have changed the way how investing. One example, sell first, build later. If you build an infrastructure in the ground, which is not used, and you're not focusing enough on yield management, this asset is eating money every minute. But if you already sell something which is using this infrastructure, you have a minimum utilization on this asset already from the beginning. And that is how we drove the build out of the infrastructure, especially in Germany over the last year. We always build new platforms. Just think about ATM, ESD, all the platforms which this industry built. But how often are we retiring platforms? So reducing our platform is ultimately important because this is capital employed. Resale of unused assets. What could we sell? What is better out of the business? I think this is what the industry already does, but there's still more to come. I have 10 billion of real estate on my balance sheet, 4.6 billion in Germany. I do not need this real estate. So the constant pressure on this one to get it off my balance sheet is helping us on the return on capital employed. So therefore, return on capital employed is even part of our portfolio analysis. And if you would say, why have you done all the network sharings? We're doing more network sharings than anybody else. The reason is better utilization of assets. The UK story is a story about scale. And even the metro transaction, we have an empty infrastructure in the US, but with a utilization which is not delivering on the capital cost, but with metro, with its customers, we immediately, better utilize the infrastructure and improve our return on capital employed. So I think it is from fundamental importance to further reiterate, to further drive this issue. If you look to the right side, you see the challenges which Deutsche Telekom is facing. These are sensitivities on our return on capital employed. The expensive UMTS license is still burdens on our shoulders. It cost us 0.5 percentage points compared to our peers. Regulatory factors have cost us 0.2 percentage points. The US impairment tower deal cost us 5.9%. By the way, this is something we haven't foreseen when we started our return on capital employed story, that we are carrying a lot of burdens from unutilized assets from the history, goodwills of 20 billion, which are now down to 14. The costs from the reunification from Germany and the build-out, which are now depreciated. Or you take the personal cost advantage in Germany, which is burdened on us on 0.5% on our return on capital employed. The good thing is we know exactly where our disadvantages are, and I promise we will focus on getting and closing this gap on this disadvantage which we are carrying. 1 billion additional Capex is affecting our return on capital employed by 0.2 percentage points, and 100 million EBITDA is affecting our return on capital employed by 0.1 percentage points. So therefore, the growth and even the EBITDA, which is coming with that one, is the biggest driver to improve the return on capital employed of that group. So therefore, even here, the story of going into an investment, going into this change of our paradigm to regain growth is very much linked to the return on capital employed story, because EBITDA is the biggest driver for improvements. I do not want to go into the areas where we are focusing on at that point in time, because I mentioned them already, but increasing the revenues, improving the profitability margin, a reinvestment rate around 1-ish for our industry, and an asset turnover of 0.6 in a minimum is something which could lead you a little bit on how we're going to improve our return on capital employed. To give you an impression, today I have 0.5 times asset turnover, very low asset turnover. And if I improve it to 0.6, this equals 4 billion more revenues. 4 billion more revenues. So therefore, squeezing the assets in a better way, utilizing them more efficiently, yield management for this industry, this will drive return on capital employed in the future. And there's another issue I like to mention in this regard. I mentioned that already 100 times to you. I think EBITDA is the wrong way of measuring this industry. Earnings per share and EBIT would be much better for an industry which is almost stable, slightly growing, and an industry is carrying around billions of assets. And if you see that, all the Capex which we generate, they increase or decrease your asset base over time. And the EBITDA is just ignoring it. You just look at the EBITDA and you just see what is coming out. But nobody's questioning how much asset got invested to gain this EBITDA number. So therefore, the EBIT would be a better steering mechanism to see what kind of costs are these guys carrying around. And especially in a area where we invest now into Germany and the US, this question gets more relevant. So we don't want to teach the market. You get the EBITDA, but in the future, we will give you a much better insight and transparency about the EBIT as well. Because, what we see, we have now squeezed, sweatened, impaired our asset base big time over the last 3 years. And what we see now is our EBIT is going up already next year. We have an improvement on the EBIT just, by less assets, less depreciation, which is a windfall from the history now, which is improving our EBIT immediately. And by the way, the same happens to our earnings per share. If you look into the planning, the best KPIs are my earnings per share and my EBIT. They are going up immediately, already next year. And the good one, we can't fuck it up. You know why? Because the depreciations are slowing down anyhow. We cannot do something about it. So therefore, we have, only to give you an impression, next year, 1.7 billion less depreciation than over the last year. The old assets are gone, they are forgotten, and now we're investing in a return on capital employed logic, which is clearly giving us a better payback, and therefore, with the profitability and the growth margin, we are able to improve our EBIT, we are able to improve our earnings per share, we are able to improve the return on capital employed. So 2 areas, the business growth and the less depreciation of the asset base. The asset base went down from over 120 billion 3 years ago, now down to 100 million next year. So that is, I think, something you should consider by looking onto our numbers. And I will definitely look more giving guidance into the markets on EBIT and on earnings per share. So now we have questioned the how. Let's talk a little bit the what we are doing. And efficiency, cost management, and return on capital management is one. But how could we raise value out of the assets? And I think our M&A team, they did a great job over the last time. I think This is a very bright and smart team. And if I compare my deals, since over the last 3 years, being it the everything everywhere deal, and I come to that in a second, even, the breakup fee, that was a big frustration for us. Don't believe us, that was easy to digest. But, at the end of the day, I would clearly do that again. The PTC partnership today is a very good cash-rich business, buy-in, the network joint ventures, and even some small acquisitions. So done deal. For the future, we should do it the same manner as we did the last 3 years. Honestly, we were heavily criticized, but by the way, not from you guys, more from the press. Why are you not expanding into emerging markets? Go to Africa. I'm glad that I'm not in Africa. Go to Asia. I know about the impairments and the problems on spectrum and all these issues in Asia. It was wise that we focused our assets where we are, strengthen the strength, and not doing big M&A. And we will not do more M&A outside our footprint, even in the upcoming future. We cannot waste our sources outside. We will be focused on the US and focused on Germany. Second, we have to reconsider whether we could create some value out of assets which we hold and to improve, let's say, the capabilities of Deutsche Telekom in its core. And therefore, everything everywhere is one story, and I'd like to talk about the IPO, a potential IPO, or the strategic review of Scout. Scout is a very attractive business, grown nicely in the past. But we want to expand that business. Should I now put more cash on Scout, or should we consider that Scout might be, a self-funding business? It will be even value enhancing for us to see how this business might trade. So we might even consider, at reasonable prices, an IPO for our Scout entity, which has nicely developed with double-digit growth over the past. And what we will do as well, without damaging our balance sheet, is we will focus and participate in future activities. I think Strato is a very good example. It's developing nicely in our portfolio, but there are even other areas, and we have a lot of, let's say, facilities now, how to drive business in the DBU, T-Venture, and in the growth areas. Let me spend one sentence on everything everywhere. This is a success story. And by the way, there were a lot of people questioned that at the beginning, saying, how could that work? That two loose cannons in this UK market, even German French, are trying to bring their business together. This will never work. And I could tell you, today, we have the clear number one leader in the UK market. Our contract customer base has grown by 22%. More than 50% of our entire customer base are contract customers. We have a significant uptake on our valuation. Okay, show me the money. Show me the money. How could we do that? We do not have to sell that business. There's no need. I do not have to refinance my balance sheet by selling assets. Not needed. But, to take a piece of that off the table, to bring it back into German business, to just, realize some value and to boost the management to go even beyond that, to be a clear differentiator in the UK market, to be the pure mobile play, British mobile play. I think this is a value. It's going to be some of the most exciting IPOs in Europe. By the way, even one of the biggest. It's the number one mobile player. But we would not do that if we would not do a smart deal. It should be a good deal. There is no need to do it. But should we consider it for value creation? I would say definitely yes. And therefore, we have with our partners in France, at France Telecom, we have now agreed to start a process, to talk to investors, to understand how you think about it, and then throughout 2013, including the market environment, creating additional value for Deutsche Telekom by maybe taking some of the money off the table at that point in time. I think a great success story, and I do not mention the LT. We will first accomplish our auction on the spectrum, and then, I think all the maybe question marks around this business are gone. The branding has been taking place, the LTE rollout is on its way, and even the spectrum is then digested and guaranteed so that we have a good story to tell. Let me come back to predictability and reliability. I always said that, and you know that from the road shows, I always talk about a well-hedged portfolio. And that was already 1 or 2 years ago. This portfolio is well hedged because we have not made adventures outside our footprint. If you look to that one, 85% of the portfolio is in markets, and that is from our risk cockpit, and I do not go into the details here, what we call more or less safe havens. The US is recovering big time and faster than the European footprint. Germany is the safe haven in the Europe environment, and Poland is a very nicely growing business in a growing economy. And interesting wise, if you look to the European pieces, I would say there is huge value inside as well. If I would apply in your shoes the multiples, this business is traded at a 4-time multiple, okay, due to the macroeconomic challenges. But if I would look into the free cash flow yield or the dividend yield of this business is entirely undervalued at that point in time. So at least you took already, some deviation on this effort or some impairments on this asset from your side. But I could tell you, I'm look different on it from a free cash flow yield. If I just apply our free cash flow yield for Deutsche Telekom, this is already a huge value take-up. So we have to more convince you, to more talk about Europe, what the value and what the risk profile of these separate entities really is, because I believe today this entity is not in your focus, and it is more valuable than we see. We have used this portfolio and the times to really reduce our interest costs. With the low interest rates, we were able to reduce our averaging, cost of capital from a lender perspective by 10% since 2010. And I mentioned already, let's say that our yields are 60% below 2010. So that gives you an impression even here. This is a hedged company. Predictability. It is not a volatile, risky asset. And by the way, this is what I want to sell here today. You see the well-balanced maturity profile? And I could tell you, I have another slide where I compare our maturity profile over the next year with the ones of our peers. And there's not another player who has this well-balanced maturity profile. There are no peak refinancing. Not at all. I have a 4 to 5 billion refinancing on a yearly basis. And only to see that 2013 OT, just this is maybe news for you, fully refinanced already beyond 2013 in Greece. And the last one is the strong liquidity reserve position. We have today 36 months of liquidity reserves in the group. So therefore we are well beyond this, let's say, our comfort zones. One sentence on the pension plans, because I always get that question from you. Is there any kind of risk which I don't know? I want to understand this risk profile. Quickly, our defined benefit obligations are at 8.7 billion in our books. And by the way, over 2012, we have adjusted, let's say, the accruals based on an interest rate of 3.5%. Which is, by the way, good average of German industry if I compare myself with, let's say, the DAX. So this is an increase of accruals which you find on the balance sheet. By the way, they don't matter. Because at the end of the day, what matters is the cash which we have to pay for the pensioners in front. This is just an interest effect, the bookkeeping. On the cash side, what you see is that we have a profile which is not increasing, it's going down. It is leveling up for the next year and then going down. Why is that? Because the obligation for civil servants, they are going down big time. And for the normal employees at Deutsche Telekom, they're slightly increasing. Overall, 0.9 billion cash flow affected over over the prospect of the next years. Now you could question, how much of that is external funded already? If everything would be funded externally, this would not affect Deutsche Telekom's cash flow at all. Today, we have an external funding of 20%. So this is, let's say, outside of Deutsche Telekom. It is, managed by a big group. By the way, at reasonable interest rates, interesting-wise. So therefore, we're going to increase this external funding to get this money out of our operation system, that we really could say cash is for business over the next year, and we're going to increase that up to 50%. Up to 50%. So that we really, let's say, have this money saved at the side, that there are no surprises from any kind of cash flow affecting, let's say, the operational business in the future. If you have more questions on that one, please don't hesitate to talk to myself or to the team later on. Coming to the debt market, because that is even a very important partner for us, and we want to be predictable and reliable for these guys as well. And what you could see here is the trend over the last years. Deutsche Telekom was very stable with this BBB plus rating over the years, or I minus, whatever you take, but in this vicinity. Our planning, including, let's say, the development of free cash flow, including the additional Capex, will not change. It will even improve. That is what you see at the end of the story. Net debt to EBITDA. We keep the comfort ratios as you know from the past. So, what has changed? The rating agency might change their corridors. And we do not want to come into the position when the corridors are changing for our industry that we have to stop our investment programs, or that we even have to, discuss the dividend again. To make a fair deal out of that, we have said, even if the rating might be BBB, it will not affect Deutsche Telekom. We could easily refinance over the next years in this regard. We do not see any kind of changes, by the way, but we just want to anticipate whatever happens in this universe, that we are predictable for everybody. That we keep our free cash flow commitment, that we keep our dividend commitment, and at the same time that we keep our undisputed access to the debt market to refinance this company at any time. I know there was a lot of discussions about dividend, and especially about the dividend in kind. Honestly, I thought it was a good idea. I know that some of you are pushing back on that one, but for me, the idea was there are companies who are from a share price affected because they are refinancing capabilities. So the more equity is in a company, the less leveraged the company would be, the more safeguarded is this company even from its shareholding, from its share price perspective. And if there would be shareholders who would be committed to leave the money in the business, they would not only improve our equity, they would even give the signal, we believe in the story of that company beyond, let's say, the next 2 or 3 quarters. It's a commitment because it's, they're giving their commitment on the stock. And therefore, we discussed that, that if we never sweat, that would be the best situation in this big, transformation phase. And therefore, we have created this dividend in kind as an option. That people could decide to leave the money in the company, that we are developing this business in the right manner, accretive for them as well. And one shareholder, one major shareholder, has very seriously considered to opt for this dividend in kind. So therefore, we do not know how the acceptance rate is. The cash, the dividend, will anyhow stay the default option, and there will be no premium whether you decide into a dividend or whether you decide into a dividend in kind. So let's see how this evolves over time. It will be, again, tax neutral. So both instruments will be absolutely equal in the way how we treat it. And this will be already apply for the dividend paid for 2012 in 2013. So the expected 70 cent, which we netted. The cumulated dilution is expected to be very limited. It's just another instrument to foster, to attract customers to go into the growth prospects of our company, to stay in this company and to give a commitment towards our equity. This brings me to the end. You know this slide, my $10,000 slide. And I'm presenting that even if you do not want to see that again, but this is the comprehensive description on, let's say, a balanced approach how we're looking at it. We have the owners, we have the debt holders, we have in the middle the company, the entrepreneurs, and the employees. Compete, transform, and innovate is the strategy. I hope you got a flavor during the last day on what we mean with this. I think we were very detailed in the way how we're going to drive this growth. But we will not do that just, on purpose. We will do that supported with a strong efficiency management, 2 billion commitment, and return on capital employed focus. And we will do that supported by portfolio management. No big M&A, strategic review of Scout and everything, everywhere in its capital market. Not a must, but maybe a good value-enhancing story for our stock. And we will do that in an environment where we keep a well-hedged risk profile, so that we keep, let's say, this low country risk profile. On the debt side, we keep the same ratios as we have laid out in the past. We don't change that. Net debt to EBITDA 2.5, equity ratio 25 to 35, by the way, to currently at 31, liquidity reserve maturing covering the maturities of the upcoming 24 months, and we keep a rating of A- BBB as an orientation for our debt holders. On the equity side, we make the third year of our 2010 commitment. And by the way, last man standing. We delivered what we promised. With regard to 2013 and 14, we thought about, would it be better to give a percentage? Would it be better to give it for 1 year? Would it be better to give it for 3 years? And after long debates, we decided to say predictability, give a clear commitment. The 50 cent is what we could deliver. And our free cash flow is supporting that. You know that. The payout ratio is 42%. For me, it's more important that you believe in the 50 cent, that we are always able to deliver, than rather having a high number and the next day you question, this free cash flow will not deliver on this dividend. So we want to convince you that this 50 is safe. And by the way, this 50 cent is in the 2 years where we transform the business. And this is guaranteed. If we do better, we could always talk. But we expect the investments. In 2015, we see a profile which is increasing. And therefore we say it would be unfair. It would be not a balanced approach if we would say we would make another 50 cent. And therefore we say this is the year where we review our profile, whether we then could go back to the 70 cent, whether we would then have another balanced approach, towards our 3 stakeholder groups. So that is why we did it, and hopefully you could follow the logic that the reliability behind that is, for me, more important than the size. Next year, 70.4 billion EBITDA, 18.4 including Metro PCS, group free cash flow with or without Metro PCS, 5 billion. Shareholder remuneration, 50-50, I mentioned that. Midterm, I think growth. Growing 2014 turnaround next year in the US, growing EBITDA 2014, coming back to 6 billion of free cash flow, improving our earnings per share to 0.8 or 80 cent, group ROCE to 5.5%, 150 basis points up, and shareholder remuneration 2015 to be reviewed then on basis on the development on our story. That's the financial contribution to the story. This is the summary, let's say, of, I think, our sessions. Thank you for listening.